Hello again. This is Andy, one of the two gray beards. Nick is here with me. We will be discussing today, in our normal fashion, what happened last week, what is likely to happen next week, and how that impacts your investments and our investment portfolio. Firstly, I'd like to say that last week was, a fairly data-filled week. There were options expirations as well that had impact on the market. But when you step back, the equity markets really were unchanged for the week. The S&P was unchanged, the Nasdaq was unchanged. But what changed was in reaction to a CPI that was in line and a PPI that was these are inflation measures, that was elevated relative to expectations. There's been a shift from a world of heavily priced in imminent recession to one that is less certain. And I think what we've been saying is that, and the data in no way changed our view, is that this is a period of time in which the economic outcomes are uncertain. And nothing clarified that in my mind based on the data we saw or the market pricing changes. Nick, what did you see?
I saw much the same as you. Um, I saw a market which, in an environment in which the yield curve went more negative, simply because we are transitioning from this idea that we are very close to a recession to an idea that the Fed is probably going to have to keep rates higher, whether it's a terminal rate that has to be higher as well, but certainly in time. So we're going from an idea that at some stage during Q2 or Q3, we're going to hit a recession and the Fed's going to ease, to an environment in which no, the economy is doing just fine. Inflation is not as benign as we had hoped, or the prospects for inflation are not as benign. And therefore, the Fed is probably going to have to go higher than the terminal rate we've been assuming, which has been just north of 5%, to probably half, five and a quarter, five and a half. That's not such a huge move in terminal rates, but certainly that they're going to have to keep rates at that level for much, much longer than the market had priced in. And therefore, we had a shift in the yield curve whereby the short end, the twos, the fives, are very offered. And the long end is, wobbling, but not doing very much.
Right. And I think the long end is in an interesting place. It's certainly influenced by the higher for longer um, Fed funds rate, in that it's dragged up by what is already heavily inverted yield curve, where long-term rates are low relative to short-term rates, and the expense for financing from levered players for going long the long end and short and borrowing short to fund them. We mentioned that in our carry video that's on our website, and that drags the yields up. But at the same time, inflation expectations remain very anchored, which keeps the long end of the yield curve stable relative to its current level and isn't likely to move much unless inflation expectations get unanchored or growth really picks up or falls in one major way. And as we said, that's unclear at this stage. So the long end, sold off a little bit, and, we're flirting with 4% at the farther end of the curve. But, it's mostly boring at this stage.
Yeah, I would agree. The things that I look at, like the 5-year inflation expectations and the 10-year break evens, it's all very stable. It's beginning to drift up, beginning to discount something, a little bit more inflation than it has been, but it's relatively stable and has been in a very tight range for the past quarter. So no way are we breaking out in inflation expectations, but we're beginning to be a little bit more cautious and less gung ho that we were even a week ago, that inflation was beaten, the Fed had done its job, and let's go risk on. So no, it's not going to be risk on. And I think what we said to you last week was that these data points were not going to resolve anything, has been proven right. And unfortunately, I don't think next week's are going to either, are they, Andy?
Right. And I guess the one thing I would like to point out on sort of now the last for 2023 is, equities are still up, but not as nowhere near as up much as they were. Stocks like Microsoft which rallied on AI along with other AI speculative plays, the heavily shorted index, and some of the meme stocks uh, have seen their highs recently, in January, evaporate a bit. And I think that's partly because there was a fair amount of uh, global inflows into U.S. assets, and the beginnings of a recession unwind trade that drove equities higher. So that fluff has been taken out, but we'll see. So let's talk about next week.
What do we have next week? We have the FOMC minutes, which might or might not contain a surprise. And at the end of the week, we have the PCE, which I would have thought is going to be in line simply because we know the components, having had the PPI and the CPI, and therefore it would be a big surprise if that was vastly out of line. And I think it's going to confirm that we are in an uncertain period for inflation, that we cannot say that the Fed has won its battle. The interesting one is going to be probably if they mention something unusual in the minutes, in the Fed minutes, which are on Wednesday, I believe. Anything you've got to say about that, Andy?
Yeah, I'll also mention two other data points just so we'll cover them. The PMIs on Tuesday. We have a short week, by the way. We're off on Monday. The PMIs on Tuesday, and about 120 billion of auctions in twos, fives, and sevens, which from the government, which, given the weakness in the front end of the yield curve, is going to be interesting to notice from a global flows standpoint in particular. So two comments. One, I'm going to be paying a lot of attention to the indirect bids that suggest foreign participation in our auctions, because they were very, very strong in January and the market sort of melted up a little bit. I'll be interested to see if they come back in February. So that's one thing. As it relates to what Nick said on the minutes, if you remember, back in January of 2022, for the first time, the minutes indicated that the Fed, and the Chairman Powell had mentioned it in December in his press conference, that the minutes contained what was a surprise to markets, that they were considering quantitative tightening and reducing their balance sheet. And they have. They've reduced their balance sheet about $600 billion over the course of the last year. So here we are with the new minutes, and we pay quite a bit of attention to the Fed and and who speaks and what they say. And we noticed at the Fed's press conference that there was no mention of the balance sheet at all. No reporter asked a question, and Chairman Powell didn't mention anything. He was then interviewed with David Rubenstein, and in that same interview, he mentioned very little about the balance sheet except to say that mortgage bonds were not being considered to be sold. But it strikes me as a risk factor that the quantitative tightening, which has been in the background for months, is still a lever that the Fed has. And given the performance of markets, given the financial conditions that have, asset prices have rallied for now almost 4 months, there's a risk factor that I don't think will happen, but we're paying attention to. any substantive change between the past minutes comments about the balance sheet and the comments made about the balance sheet in this minutes, because it's possible, not likely, but possible, that they adjust the speed of quantitative tightening or give guidance, meaning the amount that they sell. And it's possible that they are more specific about the duration of quantitative tightening. And those are very important factors.
Yeah, I think it would be a complete shock to the market, i.e., a bad shock. People would take fright if they even mention the possibility of increasing the monthly 60 billion QT. I think it's unlikely, as you do, but it's always a possibility. I mean, the market has been very resilient, and if they're going to increase it because they want to reduce the balance sheet to get to the 10% of GDP a little bit faster, then certainly they could mention it. That would be a negative shock to everything. Yields would rise throughout the curve, and I think the stock market would have a very difficult time on the back of it. I don't think it's likely, but it's good to have it in the back of your mind, and of course, we'll be watching out for it.
Exactly. I completely agree. I think the objective of getting the balance sheet down is an important long term objective of the Fed. And at the pace they're going, they're talking about quantitative tightening for 2+ years, which will be a permanent headwind, a 2-year headwind on assets. So the reason why they want to do that is because they want to have ammunition in case there's a financial crisis again, and they once again have to do quantitative easing. And they are a long way from that, the ability to restock. So I wouldn't be surprised if it happens one day. I would be very surprised if we hear anything about it during the minutes.
Right, Andy. Well, given what we've been saying about the past week and the next week, and the fact that very little actually happened to our portfolio, apart from we took some minor losses in bonds, which are probably likely to do not very much over the course of next week. What are your thoughts about what we should do with our portfolio?
Right. So again, I think the most important thing that we can say about our portfolio is we are defensively positioned, we are
Very.
underinvested, and we don't have a strong sense of which way the economic outcomes are going. But we do believe that they're likely to shift through time until there is resolution, but there is not resolution. So we remain defensive. I would say that I'm a bit more defensive on equities than I was, mostly from a valuation standpoint, more so than and that's the 18 Blue Angels. Um, and with the yields rising, holding that sort of PE is tricky. And so some of the more aggressive stocks, I think, are vulnerable to a sell off. So I was thinking, listen, we don't want to reduce our equity allocation. It's, 5% over our minimum because we believe you should always be invested at some level. And we're already heavily in cash. But I was thinking a defensive posture, um, a bit more defensive posture than we have, which is selling about half of our SPY, S&P 500, which is more exposed to some of the high flyers, and using that money to buy Dow Jones.
Yeah, it's something that certainly worked for me last week. All week I've been buying the Dow and selling the QQQs simply on a valuation basis. The defensive stocks are holding their own. They're very unlikely to go down very much. And as you said, the valuations here, especially for the high beta sector, are very, very high. And unless the high beta sector is very much helped by TLT and IEF and the whole bond yield curve, I just don't see it doing much better. I think this is a very low risk transition. If you're wrong, you're going to lose very little. And if you're right, you potentially can make quite a lot. The adjustment between the Dow and the S&Ps and the QQQs has been very sharp this year, and it's more likely to go swing back than not. So I would completely support the idea of selling half of the S&Ps and replacing them with Dow. Anything
Okay.
else that you can think about?
Well, we mentioned how inflation expectations are low, and the Fed appears to be acting higher for longer, which should maintain low inflation expectations. But I was thinking that, given how low they are, that it might be interesting to look on the yield curve to see if we could make some shifts toward something that protects you in case inflation actually starts rising more than it is currently priced.
So you'd be looking towards tip.
Yeah, and I guess the duration matches IEF. One of the things we always look at is whether it makes sense to sell calls when we want to be defensive. How are the IEF calls looking?
I've been looking at them, and they're they give you almost no advantage. I mean, certainly risk adjusted, it's almost not worth doing.
Meaning they're too cheap to sell?
They're too cheap. They're just too cheap. I think IEF is basically stuck between 95.5 and 98 for the foreseeable future. Certainly all the way into the Fed meeting. That's more or less going to be its range. And even calls struck in the middle of that range are worth very, very little. So I don't see that it's really worth selling any calls at the moment in IEF.
So you so you think we should modestly adjust the IEF to TIP sizes?
Yeah, I think if anything, that makes more sense. It's much of a muchness in either case,
I agree.
but I think it's very unlikely that it's going to make that much difference. I would rather sell the IEF on a small rally on Monday and replace with some tip. It gives us more defensive options, and also it gives us a better balance. That's what I think.
Okay, so maybe a limit order on IEF above the market, and then if we get any retracement from a rally, replace that cash with tip.
Absolutely, and that's what I'll talk about when I do the section about where our portfolio is and what the orders are in for next week.
Perfect. That makes sense. As it relates to cash, we're 35%. I don't see any reason to deploy or reduce our assets at this stage.
Cash is not trash.
It
We are
sure is.
doing just fine with it.
Absolutely. So you're going to go through the portfolio now.
Yes, I will do.
Let us talk about the portfolio. The most important thing to note is that none of the orders that we inserted last week, i.e. selling IEF rather, buying DIA and selling SPY, were filled. So we're now cancelling all three orders. Having cancelled the three orders, which is visible by these pink dots, so disregard these. As we mentioned in the previous section, what we're doing is we're swapping half of the position in IEF, i.e. 200 shares, for half a position in TIP, which is another 176 shares. So we're not actually changing the amount of money allocated. I will do that when on a small rally in IEF, and then I'll buy the tips. So really it makes no difference when you do it. And much the same for DIA and SPY. So we're selling half of the position in SPY, which is 49 shares, and we will be buying 57 shares of DIA to basically match the money that we are selling. And finally, a word about the Excel sheet. On the first tab, you have the approximate allocations. These are approximate numbers. The real numbers to the penny are in the broker statements, which you can download, and it's here in any case. The chart pack is all updated with all the levels that we are watching in each individual ticker. And finally, you have here the order statement. Please be careful, these are cancelled order, the pinks, as I just showed you. And finally, in the research, I've put in links to the 5-year inflation expectations and the 10-year break-evens, which we mentioned in this week's video, so you can follow along and you can see what we are talking about in a pictorial manner. I will always update these research and resources tabs with everything that we talk about in the video, so keep an eye out for them.
Thank you very much indeed for watching this episode, and we'll be with you next week.
We'll talk to you next week.
Bye-bye.